How are mutual funds and ETFs similar? Investors have a wide variety of mutual funds and ETFs from which to choose. In general, however, the two types of investment vehicles share a set of underlying traits that offer relatively easy diversification, professional investment management, and explicit investment strategies, such as growth or value. Both mutual funds and ETFs generally offer shares that represent a collection of underlying securities. For investors, both can provide an opportunity to increase diversification, which is an important part of any investment strategy. Investing in a portfolio that includes a variety of assets helps mitigate market risks related to a single company, geographic region, or industry. Professional fund managers oversee the underlying assets in both mutual funds and ETFs. However, their level of involvement with daily changes to those underlying assets varies depending on the fund strategy. What are the advantages of mutual funds? Because mutual funds have been around significantly longer than ETFs, they generally offer investors a greater variety of choices. The first modern mutual funds were launched in 1924, whereas the first ETF was issued almost 70 years later, in 1993. As a result, more assets are invested in a larger number of mutual funds than ETFs. However, there are a growing number of opportunities to invest in ETFs across passive and active investment strategies. In 2021, mutual funds held nearly $27 trillion in net assets in the United States compared with more than $7 trillion for ETFs. 1. The large number of mutual funds available may make it easier for some investors with specific strategic requirements to find a fund that closely matches their time horizon and risk profile. Mutual funds are generally priced once a day, based upon the net asset value of the assets they hold. At that time, investors can buy or sell shares. What are the advantages of ETFs? Unlike mutual funds, which trade only once a day, ETFs trade at stock market prices whenever exchanges are open, like individual stocks. This structure offers advantages to some investors. As with stocks, the minimum investment in an ETF is typically a single share, though some brokerage firms also allow investors to buy fractional shares. As a result, investors have flexibility in terms of when they buy and sell shares and at what price they choose to do so. Trading ETF shares through a brokerage may allow investors to use some of the advanced trading techniques related to stocks, such as limit orders, short selling, and margin trades. ETF investors are generally free to sell shares whenever they want, incurring no short-term redemption fees associated with many mutual funds. When an investor redeems shares of a mutual fund, the underlying investments are sold, which can create capital gain distributions for all remaining shareholders. In an ETF, the process is different as ETFs can leverage an in-kind redemption process. While both are subject to capital gains tax, this process generally makes ETFs more tax efficient and gives investors better control over tax implications. Is it better to invest in mutual funds or ETFs? When it comes to choosing between a mutual fund and an ETF, ultimately the decision depends on an investor's strategic goals. For example, the larger number of actively managed mutual funds available could make it easier to match a fund strategy to your specific needs than you could via any of the ETFs available on the market. Overlap exists, the differences between ETFs and mutual funds, such as costs, taxes, and availability, can tip the balance one way or another. For instance, actively managed mutual funds and ETFs may offer similar strategies with similar investment exposures. In those cases, comparing fund expenses and considering whether you might need access to the increased flexibility provided by an ETF may make the better choice clearer.